Hello and welcome to Rachel's classroom. In this video, we are going to discuss cost volume profit analysis. Cost volume profit analysis is the analysis of three variables. They are the cost, the volume, and the profit. This analysis measures variations of costs and volume and their impact on profit. Profit is generally affected by several internal and external factors which influence sales, revenue, and costs. Therefore, the cost volume profit analysis helps the management in profit planning. Profit of a concern can be increased by increasing the output and sales or reducing the cost. If a concern produces to the maximum capacity and sell, contribution is also increased to the maximum level. Now let's move on to the problems. The first sum we'll be seeing is we are expected to find the break-even volume. They've given the sales volume, that is the number of units sold, 40,000 units, and its value is 2,40,000. So you can determine the selling price by dividing the value by the number of units. That is 2,40,000 divided by 40,000 units, you'll get the selling price. They've also given the variable cost 1,60,000 and fixed costs 40,000. This question has two parts. One, we have to find the break-even volume. Second, they are asking us to find the level of sales that is required to make a profit of 1 lakh. That is, in order to earn 1 lakh profit, how much sales should be done. Okay. So to answer the first question, we are supposed to find the break-even volume. So if to find the break-even point in units, you need fixed cost divided by contribution. Fixed cost is given, contribution you have to find out. Contribution is selling price minus variable cost. So selling price, like I told you, you have to divide the value of the sales by the number of units, 6 rupees. Variable cost again, 1,60,000 divided by 40,000 units, you'll get 4. So selling price minus variable cost is the contribution, 2 rupees. If you need to find BEP in rupees, fixed cost divided by PV ratio. PV ratio is contribution divided by selling price. So contribution is 2 rupees divided by selling price 6 rupees. We will find the PV ratio 33%. So to answer the first part of the question, BEP in units, 40,000, that is fixed cost divided by the contribution, 20,000 units. If in rupees you want to find, then you divide the fixed cost by the PV ratio, that is 33.3%. So in rupees it is 1,20,000. To break even, you have to sell 20,000 units or you have to make 1,20,000. Moving on to the second part of the question. How much sales should you make to make profit of 1 lakh? So the formula for this is required profit plus fixed cost divided by contribution per unit. Required profit is 1 lakh, it's given, plus 40,000 fixed cost divided by contribution is 2 rupees is equal to 70,000 units. If you want the same in rupees, so 1,40,000, that is required profit plus fixed cost, 1,40,000 divided by PV ratio, 33.33%, rupees 4,20,000. Let's see another sum. A company has a capacity to produce 500 units per annum. The marginal cost, here by the word marginal cost, it means variable cost. Okay. Variable cost of each unit is 200 and each unit is sold for rupees 250. This is the selling price. This is the variable cost. This is the number of units produced. Fixed overheads is 12,000, which is fixed cost. They are asking us to calculate the break-even point, 1 in units, 2 in sales, that is in rupees, and 3 they are asking if what will be the profit if the output is at 90% capacity. That is, assume that at 100% they are making 500 units. So if it is reduced to 90%, what will be the profit? So first let's try to answer the first two questions in units and in value, break-even point. So to find the break-even point, first you need to calculate the contribution, and then you need to calculate the PV ratio. Contribution is selling price minus variable cost. Selling price is 250 minus variable cost, contribution. PV ratio is contribution by selling price. So 50 rupees is the contribution divided by selling price, 20%. So you substitute the values and you find the break-even point in units and in sales. To answer the third part, see, first we have to identify at 100% what are the values. 100% units is 500 units, variable cost is 250, selling price is 200. So variable cost minus selling price is 50. At 90%, so at 100% if it is 500, at 90% how much? So 90 into 500 divided by 100, you get 450 units. Similarly, we find variable cost and selling price. 90 into 250 divided by 100. So you find the difference and you identify the contribution. To find the profit, there is a formula, that is contribution minus fixed cost. 45 rupees is the contribution into 500 units minus fixed cost, 12,000. You will get the profit. One more sum under the topic. Here per unit value is not given. So how do we calculate when per unit value is not given? Variable cost 6 lakhs, fixed cost 3 lakhs, net profit 1 lakh, sales is 10 lakhs. We are expected to find the break-even point. Profit when sales is 12 lakhs and sales when profit is 2 lakhs. Okay. So to find the break-even point, we have to find the contribution and the PV ratio. Contribution is sales 10 lakhs minus variable cost 6 lakhs. So contribution is 4 lakhs. PV ratio is contribution divided by sales is 40%. So we have found the PV ratio and the break-even point. Now they have asked us to find the profit when sales amount to 12 lakhs. So here we do not know the contribution. So we can use the formula, PV ratio formula, to find the contribution. PV ratio we already know, it is 40%, is equal to contribution is unknown divided by sales 12 lakhs is given in the question. So you try to find the missing value, 4,80,000. Now you substitute it in the formula. Profit is equal to contribution minus fixed cost. Contribution is 4,80,000 minus fixed cost 3 lakhs. So the profit is 1,80,000 when sales amounts to 12 lakhs. Now the third part of the question, asking us to find the sales when profit is 2 lakhs. We substituted in the formula, required sales is equal to profit plus fixed cost divided by PV ratio. Profit is 2 lakhs plus fixed cost 3 lakhs divided by PV ratio. So 12,50,000. So when you are selling for 12,50,000, you will make a profit of 2 lakhs. In this sum, we will be seeing one more term called the margin of safety. Margin of safety is calculated in rupees, units, or even in percentage form. Margin of safety indicates the value or the volume of sales which directly contribute to profit, as fixed costs have already been recovered at the break-even point. So, being the sales beyond break-even point, it indicates the safety margin available to the firm in terms of sales revenue. So, we'll see how to calculate margin of safety. In this sum, they've given fixed cost, variable cost and sales. So first we have to find the PV ratio, contribution divided by sales. So contribution is sales minus variable cost, PV ratio. Then break even point is fixed cost divided by the PV ratio. Margin of safety is profit. Profit you have to find by subtracting fixed cost from contribution. Contribution we have already found to be 7,500 minus fixed cost is given 4,500 is equal to 3,000. So margin of safety is profit divided by the PV ratio again, which was found in the earlier part. So 3,000 divided by 0.5 is 6,000. So what will be the sales if the profit is 6,000? So we substitute in the required sales formula. Profit 6,000 plus fixed cost 4,500 divided by PV ratio 21,500. Sorry, 21,000. This is the last sum for the video. So in this sum, they have given us the total sales 3,60,000. Selling price per unit is 100 rupees. Variable cost per unit is rupees 50 and fixed cost is 1 lakh. They have asked us to find PV ratio, break even point, margin of safety, and if selling price falls to 90 rupees. Actually it is 100. If it goes down by 90 by 10 rupees and it is 90 rupees, how much is the margin of safety reducing? Okay, so to find the PV ratio, contribution divided by sales into 100. Contribution is selling price minus variable cost 50. PV ratio is contribution by sales into 100. Second is break-even point in units. Fixed cost divided by contribution. Fixed cost is given 1 lakh divided by contribution we have found earlier 50. So the break-even point in units is 2000 units. In the case of value, fixed cost divided by PV ratio. PV ratio also we have already found it in the earlier part. So 1 lakh divided by 0.50, 2 lakh. Now margin of safety. Margin of safety is this break even, actual sales minus break even. So we know the actual sales is 3,60,000 minus the break even sales, which is 2 lakhs. 1,60,000. Now moving on to the last part of the question. How much does the margin of safety reduce if the selling price falls to 90 rupees? So first let's find the contribution. Selling price, new selling price is 90 rupees. Variable cost is 50, it's given here. So 90 minus 50, 40. So as usual we have to find the PV ratio. New PV ratio is contribution by selling price. 40 divided by 90, it is 44.4%. The new break-even sales is fixed cost divided by PV ratio. Fixed cost also given in the question as 1 lakh. 1 lakh divided by the new PV ratio, 2,25,000. Now to find the actual sales. If you look at the question, they have not given us the number of units. To find the number of units, you simply have to divide the total sales by the selling price per unit. 3,60,000 divided by 100 will give you the number of units. 3,600. So this 3600 into the new selling price 90 rupees, you will get the actual sales value. So the new margin of safety will be actual sales minus break even sales, 99,000. So by how much has it reduced? This new margin of safety is 99,000. Old it was 1,60,000. So from 1,60,000 it has fallen to 99,000. The difference is 61,000. So at selling price 90, margin of safety reduces by 61,000 is the answer. Thank you.